Hello, everyone. My name is Zach Gardezy. I'm the managing partner and private wealth advisor here at Wealthstone Private Wealth Management. Today is March 21st, 2024, and this is Money Minutes, where we'll talk about the latest market headlines, and I'll also share with you my outlook for what's ahead. And so the biggest news right now is the Federal Reserve has decided, as of yesterday, to keep interest rates where they're at. And so that means the federal funds rate will stay at 5.25 to 5.5%. And so it's natural for clients to ask, well, what does that mean for my portfolio? And I think it's really important to take a step back and understand, well, what does the Federal Reserve do and who are they? And so the Federal Reserve is a central bank of the United States. They have two major responsibilities. One of them is to ensure price stability and also to help support the labor market. And so the Fed can do this by controlling interest rates and also controlling the supply of money. And so the decision as of yesterday to keep interest rates where they're at was really based on the fact that the Fed thinks, look, inflation has come down meaningfully, but it's not come down enough right now to justify lowering interest rates. However, the Fed has been pretty clear as of some of their latest statements that they still intend on lowering interest rates at least 3 times in 2024. And so we'll talk about, number one, how does the Fed really come to these decisions? And what does lowering interest rates mean for your portfolio? And so the Fed looks at inflation, especially right now, over the last couple years, as inflation's been a bit out of control. The Fed has looked at inflation as a primary source of an issue in the underlying economy. And they want to fix it, because you can't have inflation at these levels for an extended period of time. It's really bad for the economy and it could get out of control. And so if we look at 2022, inflation peaked at 9.1%. That's very high compared to their target level, which the Fed tries to shoot for a 2% inflation level. With 2%, they feel like they get enough growth in the economy. It'll maintain the labor market, but it's also not going to either cause an inflationary situation. It's also not going to cause a situation where we go into a recession. And so that 2% is that number that they try and target. And so at 9.1%, it's very clear that that type of inflation is well out of control. And so they had to take drastic measures. And the Fed had to raise interest rates dramatically in 2022. As we went into 2023, the Fed continued to raise interest rates. 2023, inflation ended the year at about 3.4%. As we headed into 2024, based on the latest reports, inflation's at about 3.2%. So we've come down meaningfully from 9.1%, but we're still not there at that 2% target that the Fed is shooting for. And so you might be wondering, well, how does the Fed, or really anybody, track inflation? And so there's a couple key data points that the Fed looks at. One of them is called the CPI report, or Consumer Price Index. It's released by the Bureau of Labor Statistics. And what the CPI helps do is it tracks the change of prices for the average goods and services in the United States. And so it's a very complex sort of calculation with a lot of data, but that's what one of the reports the Fed looks at. And it's an important report. And so the latest in February showed a 3.2% year over year increase in inflation. The next report, which really the Fed holds a little bit more weight to, is the PCE report, or the Personal Consumption Expenditures report. This report shows where are consumers spending their money. And it's really a helpful report in the sense of it provides a trend, and it's pretty dynamic in that sense. And so the Fed uses that report to also gauge what's happening or what's to come with inflation. And so taking that data, along with a lot of other data the Fed looks at, when they meet regularly amongst their leadership, they decide, well, what are we going to do with interest rates? And so the latest meeting, which was yesterday, the Fed decided to keep rates where they're at. Now there's growing belief in the market that we're heading into a period where the Fed will actually lower interest rates. And so clients are asking, well, number one, what does that mean for me? And number two, what should I do? And so let's first address, what does keeping rates steady mean for you? And so that really doesn't mean a whole lot, because that means nothing's changed. The Fed decided to just keep rates where they're at. If we remember back in 2022, where the Fed was raising rates aggressively, that was really bad for both stocks and bonds in client portfolios. And then as we head into 2024, in terms of this potential rate cutting situation that we might have later this year, you could make the assumption that that's actually going to be a boost to your stock and bond portfolios. Because if we think about it, in 2022, the Fed raised rates, they constricted the economy, they slowed things down, it hurt businesses. And in 2024, if we do get rate cuts, that should improve businesses, that should lower the cost of borrowing, potentially lower the cost of getting a home mortgage, more house buying happens, more business growth, more borrowing and expanding your businesses. And so a lot of positive things can happen when interest rates become lower. And so that's why the general assumption can be made that that's good for stocks and bonds and your overall investments. Now, when clients ask, well, what should I do differently in my portfolio? I always take a step back and say, look, we should take a look at your overall financial plan. If we haven't put one together, let's talk about it. Let's talk about your goals and objectives and what you'd like to accomplish and build something custom for you, because it's really inappropriate, in my opinion, to say, you know what, rates are going down, so you should do this. And so what I will say, though, is for any investor or client that has a lot of cash in their portfolio, it's really important for you to have that conversation with your financial advisor. And I would say you should have that conversation pretty soon, because as we've seen interest rates go up, so have the rates on savings accounts and money markets. But remember, as we think interest rates are going to come down, you may see those rates for money markets and savings accounts actually come down too. And so a lot of clients ask, well, where should I put my money next? And that's something your financial advisor would be glad to explain to you and go over with you. And so that's really generally what the Fed does, data points they look at, and the effects of rates going up or down or just staying steady. And I think it's also important to recap where we're at so far this year in the market. The S&P 500, which is really an index that tracks the 500 approximately largest companies in the United States, it's up about 10.16% as of close of business yesterday. And so the NASDAQ, which helps sort of track the technology sector, that's up about 10.23% year to date. And really, we're in March, and these are really good numbers year to date. So the market is providing some excellent results for investors, and it's something we should all be happy about. And as we look ahead, I think it's really important for us to understand that the next few months, in terms of what data comes out for inflation, is going to be extremely important. Because one of the key reasons why the market is doing so well is because the market, or a lot of investors, have priced in this belief that the Fed is going to cut interest rates. And now the Fed has made it pretty clear through some of their latest comments that they do intend on lowering interest rates at least 3 times this year. But let's just say we get some really hot inflation reports, meaning inflation is higher than expected. Well, then the Fed could change their opinion and say, you know what, maybe we hold off on lowering those interest rates, because the last thing the Fed wants to do is lower interest rates when they shouldn't, and then inflation comes roaring back. And then that becomes a really difficult issue to get under control. And so my opinion right now is, let's keep an eye on what's happening with some of this data that's coming out over the next few months. I think it's really important to look at the March 29th PCE report. That'll be a key data set. And as the Fed meets again, they'll continue to release commentary to talk about what they're going to do with interest rates. But I still believe the Fed will lower interest rates this year. But really, our eyes should be on some of this data. And you should be having these conversations with your financial advisor in terms of, am I set up right now appropriately for either this potential shift in the market, or really, is my asset allocation, so your percentage of stocks and bonds and other investments, is it set up appropriately for my goals and my objectives? And so as long as you do that, I think you'll be in good shape. If you have any questions, please don't hesitate to reach out. And thank you so much for tuning in.